Welcome to the All Blends Perfectly podcast. Keith, Ryan, Harrison, Coalition Properties, and friends talking about the intersection between lifestyle, real estate, culture, art, and everything in between because it all blends perfectly. All right, good people. Welcome back to It All Blends Perfectly. I am Harrison Beecher. This is Keith James, and this is Ryan Butler. And we're here talking about the intersection of all things real estate, lifestyle, wealth building, vibes, culture, comedy, music, all the things. Today, we're going to be talking about how you buy and how you approach that second house. Tons of conversations happen everywhere around your first home, first-time buyers, programs, all the different access to it. But there's a little bit more subtlety and nuance to buying that second and or third house. Yep. So we wanted to bring this convo and bring some context, insight, and detail. And Ryan, I want to kick it to you first to talk about the choices that people have to make when you got your first house and you say, am I going to keep this house and rent it out, or am I going to sell it? Which angle do you want to talk about?
Well, I think you got to decide for you personally what makes more sense. And part of that is like, okay, if I buy a house, I think you actually got a great story, Harris. I want you to tell it about why you chose to sell your home versus keep it. Even though you've kept other homes, and the first one, but the second one you didn't keep. So what's the options? You either keep the home. How do you tap into the equity in some way, right? And then buy a new home, or do you sell the home that you're currently in and use that equity that you've built over time to buy the new home? So those are kind of the major two options, right? Like there's two threads you can go down.
And as you think about option one of keeping it and renting it, but tapping into that equity, how do people get the cash out of that first house to move into the second house? Ryan and Keith talk about it.
Yeah, I think you got three ways to do it. The first one, if you want to buy a second home, is just save the cash.
Yeah.
If you can save the cash to buy your second home and let the current financing that you have on your home work, because anytime you stop money, it stops working.
Yes.
Right? So if you can leave the money to keep working, you like that? I'm saying like the camera.
Major key. That's a major key.
That's
major key.
Yeah, I like that.
Anytime you stop the money, that means it stops working.
Facts.
So you want to keep the money working. But if you need to utilize the money in some way, you have two other options. Your two other options are refinancing the property.
Yep.
Or doing a home equity line of credit.
Or HELOC. Somebody throw down around and say HELOC.
Yeah.
HELOC.
Yeah.
HELOC. So those are your main three options that you can use.
And Ryan, HELOC versus refinancing. What are the benefits of like a HELOC versus a refinance and so forth?
I think part of it is just looking to see like what's the interest rates these days.
Yeah.
Right? Because when you do a HELOC, that means you have the new interest rate for the next 30 years.
Yeah.
Yep.
And if you have the new interest rate for the next 30 years, you had a 2% interest, 3% interest, and now it's a 6.5%, 7% interest. You're paying a lot more money in interest, right? Where you can keep the loan you currently have at whatever percentage it is, and then get the difference between what you owe and what your property is worth. So say your property's worth $500,000, or say it's worth $750,000.
Yeah.
Right? And so the bank is going to make you keep at least 20% in there.
Right.
So that means that you could pull out money up to $600,000. Right?
Yep.
But you owe $500,000. So that means you can pull out $100,000 in a home equity line of credit or to refinance to that amount.
Yep.
But I'd rather keep $500,000 at 3% and $100,000 at 6% or 7% than to have $600,000 at 7%.
Correct.
Because your blended rate is going to be significantly lower.
Monthly cost goes up.
All of that.
And that actually affects the second deal too, right? From a monthly perspective.
Yep, because your debt to income ratio goes up.
Yep.
Good stuff. So we talked about three kind of paths people can go down when you're looking to keep it, right? It's either I save, which is the harder option for folks. And Keith, I wanted to stay on that save for a second because leveraging the other assets that you have in your life, including a life insurance policy, can be another venue that is like kind of like a forced savings that you planned into to tap into some capital.
Yeah.
Can you talk about what we both just did with the tapping into life insurance as a vehicle for savings and additional capital? I did it. Yeah.
Oh,
I didn't even know. You
Yeah.
didn't tell nobody.
Yeah.
Look at that.
Yeah.
This is breaking news,
oh,
y'all.
man, breaking
You're
news.
finding this
Yeah.
on the podcast.
This is, look, scaredy cat over here. I don't like it a lot of that. I don't like a lot of
You
that.
like the-
Outside of that
Yeah.
box, man.
Yeah.
That's my
Yeah.
guy.
Like-
But yeah, we invest, every month into a fund every
Mm-hmm.
month. And we also have life insurance policies that we use. And what's kind of cool is when you invest and you can keep your money working for you in that fund,
Mhm.
but also pull a line of credit on that money
Mhm.
to do other things with.
Yep.
So I have this big pool of money right here, and it's in the market, whether it's stocks, mutual funds, all that good stuff, and life insurance policies, and it's working. Call it $100,000 off that money as a line of credit to be able to go do and finance other deals, right? So what I'm doing is I got this money working, and then I have capital to go do other deals with.
Yep.
Right. And it's leveraged because I don't have to go to a bank to get a higher interest rate because that interest rate is typically lower
Yeah. It's yourself.
when you're pulling from yourself. When you're becoming the bank basically,
Yep.
right? For me, on the deal I just did, I pulled about $150,000 as a line of credit to do construction work for, and it was like all in like 3%.
Yeah.
By me doing that, versus if I would have went to a bank, they probably would have charged me 7-10%
At least.
at least.
Yeah.
So,
Yeah.
that's just a way to leverage and be savvy with your money and be creative, and that starts by investing early.
And I think that fits in the conversation around savings because there's choices you got to make for whatever your next move is, right? Either I am, having a capital event in my life where I'm making more money and able to save it, or I look at my monthly income, I look at my monthly expenses. How can I build in an activity that is kind of a forced savings plan? Go ahead.
No, I was gonna say to that point. For me, it was kind of in the beginning. Shout out to Matt Aaron. Uncomfortable.
Lux Wealth Management.
It was uncomfortable putting a bunch of money into this fund because I'm real estate, right? I know real estate
Seeing
deals.
more going out every month.
I
You
see-
say, no matter what I make, this got to come out every month.
Right. And it's kind of like, it goes back to my favorite motto, short-term sacrifice for long-term success. You continue to put this money over here in this pool and you're forgetting about it.
Yeah.
And it's working for you. And then all of a sudden you look up, man, not only do I have this pool of money that I can pull from, but it's continuing to build, you know? And that's important to know. Like, start early, start saving and start putting money away and forget about that money. Because when you look up in 5 years, you're going to be able to do a lot of stuff with it.
So, Keith, what I'm hearing is that you tapped into your financial instruments.
Yep.
Financial instruments are stocks, bonds, mutual funds, retirement accounts, etc. And then you also tapped into a cash equivalent, which
Correct.
is your whole life insurance cash value,
Correct.
right? So those are two different instruments, if you will, or two different ways of accessing capital.
Yep.
Cash equivalent means it's the equivalent of cash,
Yep.
and then the other one is the
Market value.
Money back.
the market in the stock market, for
Correct.
example, right?
Yep.
So that concept of forced savings, real estate is a pretty awesome forced savings plan, in my opinion, and the easiest one that most people can tap into because I got to make a monthly payment every month to stay in the house.
Yep.
And if I just do what I'm supposed to do, a chunk of that goes to principal, pays down what I owe.
Right.
Over time, value goes up. Markets go up and down, but over the long period, generally speaking, value goes up. So that equity piece that you were talking about, Ryan, if it's either your own savings plan, which is your separate money in a savings account, a forced savings plan like cash value life insurance, stocks, bonds, whatever else, or home equity line of credit where you are then actively getting someone else to give you money based on your value, or cash out refi is the kind of the third option, or getting a whole new loan based on the current new value in your equity position.
Yep. And this is all assuming that the issue is cash.
Yeah.
Right.
Yes.
So if cash is your issue, then you need to save it. You need to,
Right.
find it from somewhere else.
Right.
So that's part of the problem. Sometimes cash isn't an issue too.
Mhm.
Sometimes you have a high debt to income ratio.
Yeah.
Right. But that doesn't stop you necessarily from buying properties. There's other ways you can do that too. So we'll get into that. But we want to focus like the second home. Most of the time for your second home, it's probably a cash thing.
Yes.
As you get
Yes.
along the list,
Yeah.
it becomes less of a cash thing and more of how banks look at you from a risk perspective.
Yes.
How risky are you to
How
them?
risky are you to them?
That's such an important concept to stay on for a second, because almost everything you do with business, with money,
Yes.
with real estate is about risk tolerance personally, and how other people look at you from a risk to lend money to, a risk to work with, a risk to be in business with. And this is where starting early can be so powerful, just because
Absolutely.
the track record, the time you've got showing that you're making monthly payments, you have the forced savings plan, you got other assets, that really gives you more options down the line. But it takes some short-term sacrifice.
Yeah,
for long-term
absolutely.
success.
And Harrison, you recently just did a transaction. You bought a nice house, and you went about.
Shout out to the big
Yeah,
boy
shout out to
house.
the big boy
Moved up,
house.
moved up.
My daughter,
He was a move out buyer.
My daughter walked outside the house and said, "Dad, that's the house I want. I want the house just like Uncle Harrison. That's the
Not
house
even
I
like
want."
you.
I'm like, yeah,
Not
right.
yet,
I'm like,
not yet.
I thought we had a nice
I
house,
thought-
Yeah, Dad, but that house has 4 levels. We have 3. I'm like, oh my God.
And we ain't going nowhere for a while. We staying in that mug for a minute.
But good stuff, man. Good stuff. But you were very creative with that purchase, and you also decided to sell the home that you were in. Can you talk about that?
For sure. So on the other side of making the choice to move up, you got to think about the equity you got in your house and the way to tap into it. I chose from both a monthly payment perspective and what I was comfortable having as monthly payments out in the world. Because remember, I have my other investment properties too.
Yeah.
And I think about my total monthly debt load that, you already know I'm kind of a scaredy cat when it comes to having too much debt.
That's why you keep the money in your
Right.
pocket.
Right there. But I basically did a calculation that said for the new mortgage we got to take on, I know what that's going to be monthly. I know what my current mortgage is going to be. And I looked at what I could potentially rent the house I sold for, and the delta wasn't enough. There wasn't enough of a gap between the market value on rent and what my monthly mortgage payment was. So for me, it made sense both from a cash out and equity position and a monthly payment position to sell it. And there are different structures that you can approach to it. So,
But before you go, let's stick on that little piece right there about
that's a good piece.
about
I know where you're going.
The market rate for the rent.
Yeah.
And that. Right, because what you did is look and say, I don't want negative cash flow.
Yeah.
Right, but some people will take the negative cash
Correct.
flow because the equity in the property is pretty good, right? You had pretty good. You had 6-figure equity.
I
You
did.
say?
Yeah.
Yep.
Some people say,
And
well,
4
I
years
want
of
that
ownership. 4 years of ownership.
and 6 figures of equity. So some people would argue, well, I'll just take the negative cash flow because I can keep this asset. This asset's going to be worth, all right, I got 100,000 now, for example. It's going to be 200, 300,000. I'm going to have all this equity in there.
Yeah.
So why did you choose to, even though you were going to have good equity, why did you choose to still sell it? Like, what was it about that delta that, that had you thinking about it like this?
Great question, man. I think about the kind of entirety of my portfolio, right? Think about what serves me the best in terms of equity, cash flow, heartburn, management, stress, right? Like all those things. Yeah, because it's a real thing.
That's a real thing.
And for me, it just was not enough of the monthly income on top of it to offset the additional things I knew I'd probably have to consider for maintenance in that house. Because that's another thing. You look at every house independently. While that house was good to me, there were some things that might have been a little fragile if I had to rent it to someone else. So
what was the
one.
delta? You don't have to tell us the numbers, but what was the delta?
It was only going to be around $250 a month.
So basically you're saying, all right, I got $250 a month, right?
Yeah.
And I got, I'm going to just say a round number, $100,000 in equity that I can take and use for something else. And you looked at that math and said, all right, that $250 a month, you added up for a year, that's $3,000 in cash flow.
Yeah.
Right? And you say, I got $100,000, and of that equity I can use to buy my next home or invest in a certain way, I'm getting 3% on my money, right?
Yeah.
Now there's the mortgage pay down. There's depreciation. There's some things about that. So overall, it could have been higher, but the best use of the cash right now sounds like it was best to take it out and roll it into your next
to both reduce my total debt load and like my total monthly debt load. Because yes, I was confident I could have rented it quickly. Being a landlord in DC, has its blessings and its challenges, but most of the time it's demand. Like there's demand for nice rental properties. But that just wasn't enough. Also, $250 a month. After I move out and I don't get homestead on it,
right,
and I know the value's gone up, and like my actual taxes will go up in a calendar year. Like just the tax increase in the second or third year renting it would have eliminated that $250 a month. So that's another piece when you work with someone to crunch.
We said it's a wrap twice together
Oh,
at
my
the
bad.
same time.
We're all making eye contact.
It's a wrap.
Oh,
It's a wrap.
It's a wrap. It's a wrap.
Hold that eye contact for like 2 seconds too long. Don't be staring at me too long, dog.
But peace of mind was a lot of the decision too.
Yes.
Like I want to talk about the peace of mind because you would have had to get a tenant and you would have to manage another person, right? And sometimes we talked earlier about you have to look at your life, right? Not only your financials, but do you have the appetite to be a landlord for multiple properties, right? And sometimes if you don't have the appetite, you just don't have the appetite. I think that's
And a lot of times reason people don't have the appetite is because they don't have enough money.
yeah.
Shout out to Ian Dunlap, the master investor. He said, all those people, I got a bunch of real estate friends right now, and they pulling out their hair, and all my equity people, we're sleeping nice at night, right? Because there's no debt payment they have to do or anything like that.
Right.
Yeah, their portfolio went down, but it came back up again. And so, I mean, that doesn't mean you can't be like, all three of us right here, heavy real estate.
Yeah.
Right. But we're not only real estate.
Correct.
You can't be just real estate.
We're not. We're diversified in a lot of ways in both cash and financial instruments.
Correct.
Right. And
Buckets.
real estate.
Shout out to the
and
buckets.
Shout out
business.
to Matt. The
Right.
buckets.
So different buckets that
Yeah.
we're in. Yeah. I think that's important because most people think like, oh, y'all some real estate guys, like that's all y'all do.
Right.
Right. When really, like, we also understand, we do real estate because that's our best return on investment.
And it was the lowest barrier to entry to get into.
And it's
Like,
yep.
Yeah, and that was our skill set. So our level of skill
To get
and
to
that
it,
to get to it,
yeah.
like we learned a lot. We got there more quickly, and so we spent a lot of time in there. But there are other things that we do want to do outside of just real estate.
Yeah.
Right?
I think that's the mastery piece. When you get to third, fourth, fifth property,
Right.
you really gotta have some other stuff to show.
Absolutely.
Like your real estate can be great. That's a great foundation. But how smart are you with leveraging the equity as you get it to do different things? So yeah, back to mine. It was 250 wasn't enough.
Yep.
The capital too. The other big consideration was for the new mortgage payment on the house I was going to live in, right? Which is not anything that you consider cash flow or those other metrics for the house you're going to live in. It has to be within budget,
Right.
and without that equity from the new house, the old house, the new house would not comfortably be in budget.
Yeah.
Like period.
Yeah.
Like
Yeah.
I could have got a loan with a lower down payment, but that would have put my monthly payment on the new house to a range that, and again, we talk with both agents all over that are just trying to consider their budget, personal finance pieces, and your monthly housing budget for yourself has got to be something that you've got a clear path to know you're gonna make it work in your worst month all the time. And we had to use some of that equity to get that payment to a place that made more
I
sense.
think the exercise that you did, you sat down, you looked at your numbers,
Yes.
and you were very granular with your numbers
Yeah.
and realistic and transparent with your numbers.
Yes.
And decided this was the best decision for myself.
Yeah. And a little bit of a nuance on it I want you to talk about is like, even though that's kind of black and white across all markets, that's kind of how you look at it, right?
Yeah.
But you were buying in a shifting market,
Yeah.
right? So you had to do a couple things extra,
Oh yeah.
right, around both the finance part of it and dealing with the seller.
Yep.
That normally you probably wouldn't even thought to do because you didn't have to.
Correct.
Right. So talk about a little bit about like what did you have to do that was maybe different, uncomfortable, or the conversation hard conversation you have to get this deal to the table because you wanted the house.
Yeah. Wanted the
Right.
house. Saw the long-term potential, again, place I was going to live in, a little bit more emotion, a little bit more long-term vision.
Yeah.
And like I will literally say it is, y'all tease me, say I'm going to move in 5 years again. But I say this is a 10 plus year house, right? Like I said, every other house,
7.
4 years. Now, every other house been 4 years. 4 years in and out, right? Because that's market, get equity, all that.
Yeah.
10 years here. Like,
7.
Yeah.
I'll double up and
5,
give you 8. I'll
5.
give you double and give you
all right.
8.
Five.
Revisit 10.
Yeah.
But by knowing that it was going to be that 10-year window, first on the financing side, I wanted to get the monthly payment back to that comfortable range.
Yeah.
So that meant instead of a 30-year fixed mortgage, I looked at an interest-only product. And in past markets,
Ooh, you're dangerous.
Wow.
Interest,
man.
interest only.
Oh, Lord.
New year, new
Interest,
feature.
what?
interest only, and guess what? It adjusts.
Adjustable
my God.
interest on.
It's adjustable.
Just-
Oh my God, they're gonna
IO
take your
that
house.
adjusts.
Yeah. They coming to get it.
They coming.
coming to get it.
If you Google like those two words right away, next thing that's gonna come up is foreclosure, market crash, terrible.
Yeah,
blah,
for
blah,
sure,
blah.
for sure.
But
for
you want to
sure.
know what? You don't want to know what gave me confidence? Some of the wealthiest people I know.
Yeah.
Right? Wealthiest people I know look at how you leverage your debt to do what you got to do within time periods and increments. So the only reason that an interest-only loan made sense over a 30-year fixed is that I've got a plan within 24 to 36 months to get out of that product, right? Like I will not stay in it forever, but the money I'm going to save from a monthly perspective, dude, it was almost $2,500 a month.
Wow.
That I was able to save on a 30-year fixed versus this. And guess what? Have a capital event, which we're gonna project some capital events coming to us.
Yes.
I
need all of that. Melodies from heaven.
Right.
I can choose to make a payment to principal, so I'm not prohibited. While it is an interest-only loan, if I do have a capital event, I could choose it. All the money people are saying, keep your monthly payment low and keep your money to do other things. But I'm leveraging out soon, and I'm confident on value. The other piece that is really important. While it is a nice home relative to the neighborhood, it's not the nicest home in the neighborhood. Literally, my backyard neighbor.
I didn't say nothing, but
I'm just saying.
We was in your backyard and something's going up right now.
And I know where those numbers align.
And they've already,
So had it not been for that, and if I was literally the most expensive thing in the neighborhood, like, or ever, like that's risky, man. It'd be like, because you're assuming that your value at least stays where it is, right? If not, goes up incrementally. But also we know DC market dynamics, like those were all those pieces. So financing, interest only, first part. The second part, just around the structure and doing home sale contingency in the offer. Is that what I was able to do?
Going back to negotiate with the seller.
Oh, hell yeah. Took him to the cleaner. I mean, let's
yes. The answer is yes. You took them to the cleaners, as you should.
These guys get hype about negotiation.
Yeah.
A lot. They do.
Yeah.
I don't. I'm just going to be honest. I don't. While I understand it, I'm a certified negotiation expert. I know the rules. It doesn't like bring me joy to be like, I got them on.
Let me clarify.
Yeah.
This is negotiation for yourself.
Right.
Because for other people,
you're
negotiating hard.
All the time.
But for yourself, you let it slide a little bit.
Because it's the emotional part, man.
I told Harrison he should have just let me be his agent, and then we had to solve all these problems.
But didn't he fire you?
He did fire me 3 times. He fired me as an employee, as a client, and he wouldn't even hire me as an agent.
Yeah, I don't think you.
There was a movie about that horrible
We're not
bosses,
real friends,
right?
man.
No,
you ain't my real friend, man.
So yes, timing. July 2022.
Talk about
it was July 2022. Interest rates had gone up like literally the weeks we went under contract. Interest rates were starting to creep up. In October, when I had to lock my loan because the house was being new built, that was literally the worst week in the last 15 years for mortgage rates.
I remember that.
So as a result, I go back to the seller. We had already come to our initial terms, which were closing costs paid, all the stuff I wanted in the house because it was getting built up new.
Yeah.
Like I asked for everything and then some. Like an offer that a year ago would have not been, people would have laughed at you. Said, hell no, I'm not doing that.
Right.
But a part of negotiation is understanding leverage points. And I knew high days on market.
Yeah.
Not, no shade against anyone, not a robust coalition marketing plan or intent to sell strategy, which had less people looking at it. So they weren't talking to anybody but me. And I knew that. So that let me know, whatever your initial position is, I'm coming in way under that and asking for a lot more and asking you to put stuff in the house. And they did.
So I would like for you to put a number to the negotiation.
Yeah, how much did you negotiate?
Yeah, how much?
Give me something.
Yeah, off of from their original list price to where we actually ended up plus concession was not even original list price. List price at the time of contract was $200,000.
Wow.
Yeah, and then what was the original contract price? Add that in too.
Yeah, add that. Because that matters.
That matters, yeah.
Oh, the original
list
contract,
price?
that would have been over $300,000.
So you saved over $300,000.
Yeah, in cost, concession, closing costs, and stuff in the house. $300,000.
Hey, shout out to Beach on that, man. Shout out to Beach.
That's why I did it. That's why I was stressed the hell out, but that's why I did it because I'm like, yo,
300 G's.
300 G's, man.
Wow.
I haven't said that out loud. Wow, that's kind of
yeah.
We'll be in the house. Thank you.
Thank y'all.
Thank y'all for supporting me. These gentlemen were so good to me during this time because I was crazy and I was
I ain't stressed.
Oh, you can see the stress on his face right now.
Yeah,
turn red right now. Drink some water.
I used to pick up the phone and dial Beecher. I was like, no, I'm not gonna call him right now.
I used to call Beecher and be like, hey, Beecher, did you talk to the seller yet again?
No, he did tell me. No.
Hey, go hit him again.
Yeah, go hit him again.
Go hit him again. Hey.
Even after being like, that was the thing of the market. Knowing the market, even after we went to contract, reached and got another 10 bands.
Yep.
Right before.
Give me more.
Yeah.
Yeah.
Wow.
Because in a market, and that actually kind of brings it all around in a market like this, where there's a shifting market. The reason we use the word shift is because we don't know. You don't know what a market really is until it finishes.
Yes.
Right, yeah.
Facts.
You can tell it in
Right. So
hindsight, yeah.
you could tell in hindsight what it was.
Yeah.
All we know that it's changed,
Yeah.
and we don't know what the change is exactly, but we know it changed.
Yeah.
So a shifting market, and in shift, when chaos comes, also comes
Opportunity.
amen. There
What's
it
your
is.
quote? When others retreat. What's that quote?
The best time to take action is when others retreat.
Yes.
Yes.
And the best opportunity lies just on the other side of what is comfortable, but never on the other side of what is possible.
That's actually one of my favorite quotes from you. That one, not the first one, but the second one. I like that one.
Thank you. That's me too. I mean, unless somebody else, I just need to copyright it or something. Like you got
Copyright.
That's a
put
good
yours
one.
on the shirt, from on the shirt.
Yep.
Yeah, that's good.
All right. So all the things we talked about, moving up, buying your second house, home equity line of credit, tapping into your savings, looking at the different ways to use your equity, or selling your house. Two technical parts that you need to keep in mind if you want to sell your house in order to buy another one is making sure you have the correct contract protection.
Yes.
So you got to ask, knowing the lay of the land, knowing how much you can negotiate or not, are you going to sell your house first and then ask the buyer of your home to give you time to find a new one to buy? Or are you going to try to get a new home under contract first and ask that seller to allow you to go back and sell your home after?
Say it again. Say it again.
Say it again.
Say it again.
Two main options when you're buying and selling. First is, do I sell my home first and or get a contract and then go search for a new one to buy? Or do I find a home to purchase, get that under contract, and ask that seller to give me time to sell? In both situations, you can have the protection that if it doesn't work out on one end or the other, you still have a home, you still have a place. But I was just talking with some sellers today about this. Each kind of presents a slight reduction in your ability to negotiate because there's uncertainty. If on the sale side, I say, hey, Mr. or Mrs. Buyer that wants to buy my house, I'm gonna go into contract with you, but you got to give me 6 weeks to find another house. And if I don't, I'm not leaving.
Right.
There are some buyers that see that and say, nah, man, I want to know for sure once I start
Right.
up, I've taken mental possession, I've done my inspection, all that, like I want to go.
Yeah.
So that will reduce the amount of buyers that are interested if you go that route.
Right.
On the other side, if you say, hey, Mr. and Mrs. Seller, I want to get under contract on your house, but after I get under contract, then I need a week and I'm gonna put my house on the market and I need 2 months to try to sell my home. If I can't sell my home in those 2 months, sorry, y'all just got to go back to market and find somebody else. Right.
Yeah.
So I was able to actually get the latter, which is again a sign of a shifting market.
Yeah.
Because you would have never had a seller giving you that much time to do
Right.
it.
Not
and,
a chance.
And
What?
it all blended
It's a wrap.
perfectly. It came
All
together.
blended
It came-
perfectly.
It just
All blended
I'm glad that worked
perfectly.
out for you.
the
man.
timing. Yeah.
That's dope.
And I'll be back. Dope, man. So I think this has really been a good conversation to talk about two main buckets for what people do for their second home. Future convos, I think we can dig a little bit deeper into third and fourth and different sources of equity. But
Financing.
key takeaways, give me your two main nuggets from this convo people should remember, Ryan.
Yeah, I think the two main nuggets are that you never know what you can get until you ask for it.
Yeah.
Yeah.
Right. And in uncertain times, you can ask for ridiculousness. So I think you should.
You can.
Yeah.
Never know.
I'll just stick with one.
Anything? What's your main nugget? Two main nuggets. What's your main?
There's different ways to leverage, to use, and financial instruments that you can use to buy real estate out here in the marketplace. Just research and understand what fits you perfectly, so that it makes sense for you.
What's yours?
My main thought is that, the second one, there's a little bit more nuance and difference, but it's the same general process. You just got to start sooner. I think the earlier you start and get ready with either the savings plan, understanding the HELOC, identifying what your rental delta or spread might be, the more empowered you are to go do it. Because good opportunities on the purchase side often don't have a big window that you got to decide. So the more ready you stay, more empowered you are to take action.
Stay ready. You don't have to get ready.
Stay ready.
Hey.
Get ready. All right. Thank you so much for joining in on this conversation. All Blends Perfectly is on Instagram at All Blends Perfectly. I am at HL Beach. He is at Keith James Realtor. This is at Ryan Butler Hoya. And our team is at Coalition Properties. Thanks for joining in with us. We'll see you next time.
All right.